Hi everyone, welcome to my introduction. I'm Andres Capolo, and today I'm going to take you through the financial analysis between the global giant Nike and the emerging American company Under Armour, both leaders in the sportswear industry. The financial analysis is different from other types of analysis in many ways. It's based first on the company's accounting compared to the business environment, and the goal is to better understand the strengths and the weaknesses of the company being studied. In these cases, Nike and Under Armour. And the goal is also to test the soundness of the enterprise for its financial results. This serves to determine, as accurately as possible, its possible developments, which leads to the assessment of solvency and determination of real value to invest in its security. Let's take a quick look at the key points that I found about Nike. We all know that Nike is an extremely well-known brand around the world that still dominates all markets today. Nike is the world's largest supplier of sports apparel and footwear. The part that stands out immediately is the fact that most of Nike's revenue comes from North America. Financially, the company's stock price and financial performance depend on currency fluctuations, consumer tastes, emerging market growth, and technology. At first glance, it might be a brand to invest in without even thinking about it. However, I've learned during these weeks of study what elements to consider to understand whether the company is a good investment or not. Turning now to Under Armour, let us immediately consider the fact that the barriers to entering the sportswear industry are very high. Under Armour has managed to find its place in the market by marketing primarily American football, and he has done a very good job over the years, and the data prove it. The main competitors are, of course, Nike and Adidas, and some others, which have historically had much higher revenues than Under Armour. The innovation of materials used by Under Armour allows it to avoid the disadvantage of buying the same materials at lower volume and higher cost than its competitors. So the question is, which company should we invest in? Let's find it out. In this slide, we can see the difference between the arrow A and the arrow E of both companies. Arrow A, return on assets, is a balance sheet ratio that measures the profitability of the company's assets and gives us an idea of how much all the assets held by the company have returned, the stability of the company in creating value through the asset held. In this case, we can see the arrow A of Nike higher than Under Armour, and this means that the company manages to make the most of assets at its disposal. Arrow E indicates the return on equity, that is, in the economy return on the investment made by the company's shareholders. The higher a company's ROE, the more attractive the company is on the stock market. Here is highlighted that in both indexes, Nike has a larger number, and a very positive note if you are wondering whether to invest or not. Here we have two measures of profitability, net income and gross profit. Profitability is a measure of an organization's profit relative to its expenses. More efficient organization will make more profit as a percentage of their expenses than less efficient ones, which must spend more to generate the same profit. Here we see that Nike has a net income almost twice as high as Under Armour, but in turn, Under Armour has a slightly higher gross profit margin than Nike. Let's take a quick look on solvency analysis. Solvency refers to a company's long-term ability to meet its financial obligations, such as, for example, repaying debts. Solvency ratios are a set of key parameters for determining this ability and company's overall financial position. According to analysts, if we have a number less than 1, it should be considered a positive parameter because it means that we have less debt to repay. In both cases, we find two very similar numbers. 0.65 and 0.61. The productivity analysis is conducted to identify areas for potential productivity improvement projects based on a statistical data collected during the analysis. The accounting receivable turnover ratio is an accounting measure used to quantify how efficiently a company is in collecting receivable from its clients. The ratio measures the numbers of times that receivables are converted to cash during a certain period. A high ratio may indicate that corporate collection practices are efficient with the quality customers who pay their debts quickly. About the days sales outstanding, the higher is the DSO, the higher the working capital, and the lower the cash flow. And here we can see that we have two very similar numbers. Instead, Under Armour has a better cash conversion cycle, which expresses the time, of course, measured in days, that it takes from a company to convert its investments in inventory into cash flows from sales. Vertical analysis makes it easier to understand the correlation between individual balance sheet items and the final result, expressed as a percentage. In this case, we find that Nike has a lower percentage of Under Armour, which means that Nike has its assets better distributed and slightly lower risk rate. This analysis becomes interesting when related to the horizontal analysis, and I will discuss later. Turning to liquidity analysis, the figures that are highlighted are the current ratio, the quick ratio, and the working capital. The current ratio measures a company's ability to pay its short-term obligations. The higher the current ratio, the more the company can pay its obligations. Again, we have two very similar figures indicating that both companies can pay their obligation instantly if they wish. About the quick ratio, we can say that is an indicator of a company's short-term liquidity. Um, it measures a company's ability to meet its short-term obligations with the most liquidity assets. The higher the quick ratio, the better the company's position. Um, a positive net working capital indicates that the company can pay suppliers, banks, and other current debts with immediate and deferred liquidity, such as cash, accounts receivable, and inventory. We can see that Nike has more liquidity and Under Armour less, but they are still positive numbers. Horizontal analysis is used to analyze the following three elements. The figure that probably jumps out at you is the minus 34.44%, speaking of net income from the previous year to the recurring year. Cash flow from operating activities is an important benchmark for determining the financial success of a company's core activities, and positive or increasing cash flow from operating activities indicates that the company's core business activities are thriving and that 212.33% is worth nothing. As for the balance sheet section, we find many interesting data listed in this table. We find net non-operating assets, operating assets, and net operating assets. However, my attention immediately goes to RNOA with a value of 51.79%, more than double of Under Armour, which means that the company has a higher level of operating performance than Under Armour. Another curious figure is Under Armour's no AET. which shows that for every dollar of operating assets, Under Armour has 0.86 more sales revenue than Nike. And about Flav, we have pretty much a similar value. Finally, we find the statement of cash flow. The first item that appears in the is the operating cash flow, which provides a clearer picture of a current reality of business operations. Cash flow from investments includes all purchases of capital assets and investments in other business ventures. Cash flow from financial includes all proceeds from issuance of debts and equity and payments made by company. These almost all negative numbers might scare us, but a negative cash flow from investing or financing activities is not always negative. To evaluate a company's investing or financial activities, investors need to look at the company's specific situation in more detail. The other number to emphasize is the Under Armour's net cash flow. Cash flow is the net amount of cash and cash equivalents flowing in and out of a company in a given period. And if a company if has a positive cash flow, its liquid assets are increasing. In this case, we are looking at sufficient numbers to confirm that Under Armour is growing a lot as a company. As we come to an end of this analysis, we are faced with a more specific picture of the financial aspects of the companies analyzed. I must admit that it was challenging to do such work as this teaches you to go deeper and not just dwell on greatness or fame of a brand. There is no question that Nike is a global giant and will remain so in the years to come. Its strong Nike brand image and its sponsorships with the world's top sport teams and athletes provide the company with a wide economic moat. Nike also defines itself as it is a growth company, both statistically and in terms of its intentions. Indeed, this company wants to continue to expand, grow, and dominate the market. I would invest in Nike as we are talking about a solid investment in a market where it's a queen and where it's continuously expanding. However, the financial analysis that I've done has shown a lot of data that should not be underestimated, indeed should be emphasized. Reading various articles on and having a disposal of a lot of data, I concluded that I would also invest in Under Armour because it's a company that is very convincing to me. It's an expanding company that produces quality materials and is a very large user base. It has a CEO, which is Frisk, who in 2 years post pandemic has been able to rise from damage done by COVID. It has almost halved the numbers of products offered, focusing on the brand of on the most profitable ones. And also the 2021 accounts highlight the positive result of the cure. Revenues, which had plummeted 16% to 4.4 billion in 2020, jumped to 5.6 billion plus 27%, far exceeding the 2019 level. For all these reasons, I would invest in both companies. One, because it's a very, very solid investment, and everybody everybody should invest in Nike. But I would also recommend to invest in Under Armour because it's a very emerging company and it's gonna be one of the top company in the world in the next years. So thank you very much and have a nice day. I found The note of page 9 section risk factors, very interesting. Also highlighted among the risk factors are forward looking statements, which include any statement that may predict, anticipate, or indicate future results, performance, or achievements, and may contain the words believe, anticipate, expect, etc. That's amazing how everything is in this society is controlled. Another element is expressed on page 1, concerns sales through Nike direct operations. A curious fact is that products are manufactured by independent contractors, and footwear and apparel products are manufactured outside the United States. A final curious fact is found on page 29 of Under Armour 10K, where it is pointed out that net revenues increased by 27%. This figure is then joined by other figures in sharp increase. This shows that this company is growing considerably and will become even bigger in coming years. I would say last but not least, I wanted to share with you guys a very interesting article that I read about, and speaking about the projection of Nike's dividend and dividend yield, assuming on average dividend growth rate of 7% per year. So in this article is saying that Nike's average dividend growth is assumed to be 7% per year. Due to its strong competitive position, growth prospects, low dividend payout ratio, only 30.86%, and average dividend growth rate of 11.2% over the past 5 years, Nike should be able to increase its dividend by at least 7% per year on average. And another indicator showing that Nike should be able to increase its dividend by at least 7% on average per year is the company's 5-year average diluted EPS growth rate of 16.24%. The table shows Nike's accumulated dividend, assuming a dividend growth rate of 7% per year. And it can also be seen that in 2042, 54.19% of initial investment will be received in the form of dividends, and 123.30% after 30 years. Instead, in this graph, we assume that Under Armour will have a dividend payout ratio of about 30% in 2023, similar to Nike's. For the calculation that follows, an average dividend increase of 3% per year from 2023 will be assumed. Due to the uncertainty of Under Armour's dividend and the fact that the company currently pays no dividend, more conservative estimates are made for its growth rate than for Nike. Below are the result of the Under Armour's accumulated dividend, assuming on an average annual growth rate of 3% starting in 2023. In 2042, you would have received 59.09% of your initial investment in the form of dividends. In 30 years, the dividend yield would be 5.18%, and the accumulated dividend would be 104.62%. Nike's dividend yield would be 9.2%. And after 30 years, the accumulated dividend would be 123.3%.